Most people believe their money is always available. They assume that if the balance is there, access is guaranteed. But inside the modern financial system, access to money is never absolute. Because what appears as ownership is often just conditional permission. And once you understand how that permission actually works, the idea of having full control over your money begins to look very different. This is not about a single policy or a sudden change. It is about how the structure of banking has evolved over time. A system where money does not simply sit and wait. A system where access depends on rules that operate continuously beneath the surface. Rules that most people never see. The first assumption that begins to break is the idea of storage. People imagine a bank account as a digital vault. A place where money is held securely until they decide to use it. But that is not how modern banking functions. When money enters a bank, it does not remain idle. It becomes part of a dynamic financial system. It is recorded, allocated, and integrated into the bank's broader operations. The depositor does not hold the money itself. They hold a claim. A claim that can typically be accessed on demand. But only within the conditions defined by the system. Those conditions are rarely discussed. Because under normal circumstances they are invisible. Transactions go through. Payments clear. Access feels immediate. But that sense of immediacy is produced by infrastructure. And infrastructure always operates according to rules. The moment a transaction is initiated, it does not simply move from one place to another. It enters a process. A process that evaluates whether that movement is allowed. This process happens in milliseconds. But within that time, multiple systems assess the transaction. Balance verification, fraud detection, compliance screening, behavioral analysis. Each layer asks a question, not whether the money exists, but whether the transaction should proceed. Most of the time the answer is yes. And because it is usually yes, people assume it is always yes. But the system was never designed that way. It was designed to decide. That distinction matters. Because a system that decides can also refuse. And the authority to refuse is built into the structure itself. This authority did not appear suddenly. It developed gradually, layer by layer, regulation by regulation, technology upgrade by technology upgrade. Each addition introduced new capabilities, better fraud detection, stronger compliance systems, more advanced monitoring tools. Individually, these changes made the system safer, more resilient, more capable of identifying risk. But collectively, they created something else. A financial environment where access to money depends on continuous evaluation, not just ownership, not just balance. Evaluation. This is where the idea of guarantee begins to dissolve. Because a guarantee would mean unconditional access. And unconditional access does not exist inside a system that must constantly verify activity. Banks are required to monitor transactions. They are required to detect patterns associated with risk. They are required to intervene when something does not align with expected behavior. These requirements are not optional. They are embedded into the regulatory structure of the financial system. Which means the system is designed to act before problems fully emerge, not after. That shift from reaction to prevention changed how money behaves. In a reactive system, transactions move freely unless something goes wrong. In a preventive system, transactions are evaluated before they are allowed to proceed. The evaluation introduces uncertainty, not visible uncertainty, but structural uncertainty. Because each transaction depends on passing through systems that operate independently of the account holder. The person initiating the payment does not control those systems. They do not see the criteria being applied. They do not influence the decision. They only experience the outcome. And most of the time, the outcome reinforces the illusion of control. The payment goes through. The transfer arrives. Nothing appears restricted. But the absence of restriction does not mean the absence of control. It simply means the system approved the action. At that moment, under those conditions, this is where the system becomes difficult to perceive. Because it does not need to restrict access frequently to maintain control. It only needs the ability to do so when necessary. That ability exists at all times. Embedded in the infrastructure. Waiting to be used if the system determines it should be. A recipient account flagged within a broader network. Sometimes they are procedural. A requirement to verify identity under specific conditions. From the outside, these events can feel unpredictable. But from within the system, they follow defined logic. logic that prioritizes risk management over seamless access. This creates a subtle asymmetry. The account holder experiences money as something they own. The system treats money as something it must regulate. These two perspectives coexist, but they are not aligned. And that misalignment becomes visible only when access is interrupted. At that moment, the underlying structure reveals itself, not as a failure, but as a feature designed to maintain the system's integrity, even if it temporarily overrides individual expectations. If you want to understand how these hidden financial mechanisms work before they affect you, consider subscribing, because most people only begin to notice them when the system has already acted. The deeper shift is not just about control. It is about how money itself is defined within the system. Historically, money could exist independently of institutions. Physical currency allowed for direct control. Possession equaled access. There were no intermediaries evaluating whether a transaction should occur, no systems analyzing patterns. No permissions required. Digital finance changed that entirely. Today, most money exists as entries within institutional systems. Accessing that money requires interacting with infrastructure. Infrastructure that is designed to monitor, evaluate, and regulate financial activity. This transformation introduced efficiency, speed, global connectivity, but it also introduced dependency. Dependency on systems that operate according to institutional priorities, stability, compliance, risk reduction. These priorities shape how the system behaves, and they influence when access is granted or delayed. Over time, as financial systems become more interconnected, this dependency increases. Transactions pass through multiple layers: banks, payment networks, clearing systems, regulatory frameworks. Each layer applies its own rules. Each layer has the ability to intervene. The transaction succeeds only if it passes through all of them. This is not a temporary condition. It is the architecture of modern finance. And as that architecture becomes more complex, the idea of guaranteed access becomes harder to sustain, because guarantees require certainty. And complex systems operate on conditions that evolve, conditions that adapt, conditions that are not always visible to those using the system. This is why the rules often feel unchanged, because they are not presented as changes, they are implemented as updates. Adjustments within the system, refinements to processes, enhancements to monitoring. Each change appears small, but collectively, they alter how the system operates, gradually shifting the balance between access and control, without requiring public awareness. Without requiring explicit acknowledgement, the system simply becomes more capable, more responsive, more controlled. And as it does, the definition of access continues to evolve, not in theory, but in practice. The account still shows a balance. The interface still looks the same, but the conditions governing that balance are no longer what they once were. They have been rewritten, quietly, incrementally, until the difference becomes noticeable, not through explanation, but through experience. A delayed transfer, a declined transaction, a request for verification that did not exist before. These moments do not introduce new rules. They reveal existing ones, rules that were already in place, already active, already shaping how the system operates, long before the account holder became aware of them. And once that awareness emerges, the perception of money begins to shift, not as something guaranteed, but as something conditional. Conditional on systems that operate continuously in the background, systems that do not pause, do not assume, do not rely on perception. They evaluate, they decide, they enforce. Quietly, consistently, without needing to announce themselves. Have you ever experienced a moment where your bank delayed a payment, declined a transaction, or asked for verification in a way you didn't expect?